Welcome back to the channel, Financial Freedom Seekers. Today, we're embarking on an epic journey through one of the most comprehensive, transformative, and actionable personal finance books ever created, Money, Master the Game by Tony Robbins. This isn't a quick read summary. This is a deep dive, chapter-by-chapter exploration designed to give you the full power of Tony Robbins' masterpiece without having to read all 700-plus pages yourself. Tony spent over 4 years researching, interviewing, and learning from more than 50 of the world's greatest financial minds. Legends like Ray Dalio, Warren Buffett, John Bogle, Carl Icahn, Paul Tudor Jones, and many others. He distilled their collective wisdom into 7 simple, sequential steps that anyone at any income level can follow to achieve true financial freedom. If you've ever felt overwhelmed by investing, confused by financial jargon, frustrated by hidden fees, or simply unsure where to start your journey to wealth, this summary is for you. We're going to break down every major concept, every psychological insight, and every practical strategy in clear, conversational English. So grab a notebook, hit pause whenever you need to, and let's master the game of money together.
Foundational truth. The psychology of wealth comes first. Before we even touch a single investment strategy, Tony Robbins establishes the most important principle in the entire book. 80% of financial success is psychology. Only 20% is mechanics. Think about that for a moment. Most people spend all their time searching for the next hot stock, the perfect mutual fund, or the secret trading strategy. But Tony argues that your mindset, your beliefs about money, your emotional relationship with wealth, and your ability to stay disciplined during market volatility are far more important than any technical knowledge. Here are the core psychological shifts you must make. First, understand that money is a tool, not a goal. Money amplifies who you already are. If you're generous, money lets you give more. If you're fearful, money might make you more anxious. The goal isn't to accumulate digits in a bank account. The goal is to use money to create freedom, security, impact, and joy in your life and the lives of others. Second, recognize that wealth is created by providing value. The most financially successful people aren't those who hoard or speculate. They're those who solve problems, serve others, and create genuine value in the marketplace. When you focus on how you can help more people, money naturally follows. Third, master your emotions. Fear and greed are the 2 emotions that destroy more investment portfolios than any market crash. Fear makes you sell at the bottom. Greed makes you buy at the top. The wealthy learn to act based on strategy and principles, not emotion. Fourth, believe you deserve financial freedom. Many people subconsciously believe that money is evil, that rich people are corrupt, or that they don't deserve abundance. These limiting beliefs become self-fulfilling prophecies. You must consciously adopt empowering beliefs. I am capable of creating wealth. Money allows me to serve at a higher level. I deserve financial peace. Tony emphasizes that without these psychological foundations, even the best investment strategy will fail because you'll sabotage yourself when things get tough. So before you invest a single dollar, invest time in mastering your mindset. Step 1, make the most important financial decision of your life. Pay yourself first. The very first actionable step in Tony's 7-step system is deceptively simple but profoundly powerful. Save at least 10% of everything you earn automatically and invest it for your future. This is called paying yourself first, and it flips the traditional spending model on its head. Most people earn money, pay their bills, spend on wants, and then save whatever is left, which is usually nothing. Tony teaches you to reverse that sequence. The moment money hits your account, 10% immediately gets transferred to your investment accounts before you even see it. Why is this so critical? Because of the magical force of compound interest. Albert Einstein reportedly called compound interest the 8th wonder of the world. When you consistently save and invest, your money doesn't just grow linearly, it grows exponentially. $1 invested today can become $10, $20, or even $50 over decades, depending on your rate of return. Let's make this concrete. If you save just $40 per week, that's less than $6 per day, and invest it with an average annual return of $800,000. And that's without ever increasing your contribution. If you start with $100 per week, or if you increase your savings rate as your income grows, the numbers become truly life-changing. Tony shares a powerful story about a janitor named Ronald Reed who accumulated over $8 million by consistently saving a portion of his modest income and investing it wisely in blue-chip stocks over decades. Ronald wasn't a genius investor. He wasn't wealthy to begin with. He simply mastered the habit of paying himself first and letting time and compounding do the rest. Here are practical tips to implement step 1. Set up automatic transfers with your bank so that on payday, before you can spend anything, 10% moves to your investment account. Out of sight truly means out of mind and into your future. If 10% feels impossible right now, start with 3% or 5%. The habit matters more than the amount at the beginning. Once you prove to yourself that you can save consistently, gradually increase the percentage. Track your progress visually. Create a simple spreadsheet or use a free app to watch your savings grow. Seeing that number increase reinforces the behavior and builds momentum. Remember Tony's powerful reframe. You cannot afford not to save. Every dollar you don't save today is a dollar that won't be working for you tomorrow. When you don't save, you're trading your most precious asset, your time, for money, forever. But when you save and invest, you're buying your freedom, $1 at a time.
Step 2. Become the insider. Know the rules of the game so you don't get played. Once you've committed to paying yourself first, the next step is education. Tony Robbins pulls back the curtain on the financial industry to reveal 9 pervasive myths that keep ordinary people poor, while the wealthy and the industry itself get richer. Let's walk through each myth and its reality in narrative form. The first myth is that professional money managers can consistently beat the market. The reality, supported by decades of data from sources like Standard & Poor's, is that over a 15-year period, approximately 96% of actively managed mutual funds fail to outperform simple, low-cost index funds. Yet the industry continues to sell the dream of beating the market because it generates fees. The second myth is that investment fees are small and insignificant. The reality is that fees are the single biggest predictor of your long-term returns. An average mutual fund might charge 2 to 3% per year in hidden fees. Over 30 or 40 years, that 3% can consume 60% or more of your potential returns. A difference of just 1% in fees can mean hundreds of thousands of dollars less in your retirement account. The third myth is that the returns you see advertised are the returns you'll actually receive. The reality is that advertised returns are often gross returns, before fees, taxes, and inflation. Your net, after fee, after tax, after inflation return is what actually matters, and it's often dramatically lower than the glossy brochures suggest. The fourth myth is that your broker or financial advisor has your best interests at heart. The reality is that most brokers are held to a suitability standard, not a fiduciary standard. This means they can recommend products that are suitable for you, but that also pay them higher commissions. A true fiduciary is legally required to put your interests first, always. The fifth myth is that your 401k plan is a complete retirement solution. The reality is that many workplace retirement plans are loaded with hidden fees, limited investment options, and confusing choices that can significantly erode your growth over time. You must actively review and optimize your plan, not just set it and forget it. The sixth myth is that target date funds are a perfect set and forget solution. The reality is that these one-size-fits-all funds often have higher fees than building your own diversified portfolio, and their asset allocation may not match your personal risk tolerance or goals. The seventh myth is that all annuities are bad. The reality is nuanced. While many annuities are overpriced and overly complex, certain types of annuities, when used strategically, can provide valuable guarantees and lifetime income protection that are difficult to replicate elsewhere. The eighth myth is that big risks are necessary for big rewards. The reality is that true, sustainable wealth is built through risk management, not speculation. The world's greatest investors focus first on protecting their capital, then on growing it. They seek asymmetric opportunities, where the potential upside far outweighs the potential downside. The ninth, and perhaps most dangerous myth, is that you can start later. The reality is that time is your most powerful financial asset. Because of compounding, starting to invest in your 20s versus your 30s can mean the difference between retiring with $2 million or $4 million, even if you invest the same total amount. Waiting is the most expensive decision you can make. Tony's solution to all these myths is simple but profound. Become an educated consumer. Learn the language of finance. Ask tough questions about fees, conflicts of interest, and performance. And whenever possible, work with a fee-only fiduciary advisor who is legally obligated to act in your best interest. You can find qualified fiduciaries through organizations like the National Association of Personal Financial Advisors.
Step 3. Make the game winnable. Know the exact price of your dreams. Most people fail to achieve financial freedom not because they lack intelligence or opportunity, but because their goals are vague. I want to be rich or I want to retire early are not actionable goals. Tony teaches you to get ruthlessly specific. Here's the framework. First, calculate your annual living expenses. Not your dream lifestyle expenses, your actual, current, essential expenses. Include housing, food, utilities, transportation, insurance, healthcare, and a modest amount for personal spending. Let's say your essential annual expenses are $51,000. Next, decide on a conservative, sustainable withdrawal rate. Tony, drawing on research from financial experts, suggests using 4% as a safe starting point, though he often uses 7% for more aggressive planning when combined with other income sources. Now, do the math. Divide your annual expenses by your withdrawal rate. So 51,000 divided by 0.07 equals approximately $728,000. That is your financial independence number. The amount of invested capital you need to generate $51,000 per year in passive income without depleting your principal. This number is powerful because it transforms an abstract dream into a concrete target. Instead of vaguely hoping to be rich, you now have a specific milestone, $728,000. And you can break that down further. If you're starting from zero and expect an 8% annual return, you can calculate exactly how much you need to save each month to reach that goal in 10, 15, or 20 years. Tony also introduces 5 distinct levels of financial freedom, allowing you to celebrate progress along the journey. Level 1 is financial security. At this level, your passive income covers your most basic needs: housing, food, utilities, and essential transportation. You no longer live paycheck to paycheck. You have a foundation of peace. Level 2 is financial vitality. Here, your passive income covers your basic needs, plus health, education, some entertainment, and modest travel. You're not just surviving, you're thriving with margin. Level 3 is financial independence. Your passive income fully replaces your earned income. You never have to work again if you don't want to. Work becomes a choice, not a necessity. Level 4 is financial freedom. Your passive income allows you to live luxuriously. Premium travel, dream home, philanthropy, and experiences without financial stress. Level 5 is absolute financial freedom. Your wealth is so substantial that you can create legacies, fund causes you care about, and impact generations. Money is no longer a constraint on your vision. The key insight: you don't have to aim for level 5 on day 1. Pick the next level that feels achievable, and focus there. Each level builds on the last, and each brings more freedom and joy. This number is powerful because it transforms an abstract dream into a concrete target. Instead of vaguely hoping to be rich, you now have a specific milestone, $728,000. And you can break that down further. If you're starting from zero and expect an 8% annual return, you can calculate exactly how much you need to save each month to reach that goal in 10, 15, or 20 years. Tony also introduces 5 distinct levels of financial freedom, allowing you to celebrate progress along the journey. Level 1 is financial security. At this level, your passive income covers your most basic needs: housing, food, utilities, and essential transportation. You no longer live paycheck to paycheck. You have a foundation of peace. Level 2 is financial vitality. Here, your passive income covers your basic needs, plus health, education, some entertainment, and modest travel. You're not just surviving, you're thriving with margin. Level 3 is financial independence. Your passive income fully replaces your earned income. You never have to work again if you don't want to. Work becomes a choice, not a necessity. Level 4 is financial freedom. Your passive income allows you to live luxuriously. Premium travel, dream home, philanthropy, and experiences without financial stress. Level 5 is absolute financial freedom. Your wealth is so substantial that you can create legacy.
Fund causes you care about and impact generations. Money is no longer a constraint on your vision. The key insight: you don't have to aim for level 5 on day 1. Pick the next level that feels achievable and focus there. Each level builds on the last, and each brings more freedom and joy. Step 4. Make the most important investment decision: master asset allocation. If there is one technical concept that matters more than any other in long-term investing, it is asset allocation. Tony Robbins emphasizes this repeatedly. How you divide your money across different types of investments, stocks, bonds, real estate, commodities, cash, is far more important than which specific stocks or funds you choose within those categories. Why does asset allocation matter so much? Because different asset classes perform differently under different economic conditions. Stocks tend to grow wealth over the long term, but can be volatile in the short term. Bonds provide stability and income, but may lag during high inflation. Real estate can hedge against inflation and provide cash flow. Gold and commodities often rise when confidence in currencies falls. By diversifying across uncorrelated asset classes, you reduce your overall portfolio risk without necessarily sacrificing return. When one asset class is down, another may be up, smoothing your journey and helping you stay invested through market cycles. Tony shares Ray Dalio's famous All Seasons portfolio as a powerful example of strategic asset allocation. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, designed this portfolio to perform reasonably well in any economic environment: inflation, deflation, growth, or recession. Here is how the All Seasons portfolio is allocated, described in words rather than a table. 40% of the portfolio is allocated to long-term U.S. Treasury bonds. These tend to perform well during deflationary periods and economic slowdowns. 30% is allocated to U.S. stocks, which drive long-term growth during periods of economic expansion. 15% goes to intermediate-term U.S. Treasury bonds, providing additional stability and income. 7.5% is allocated to gold, which acts as a hedge against currency devaluation and systemic risk. And the final 7.5% is allocated to a diversified basket of commodities, which tend to rise during inflationary periods. The beauty of this allocation is its balance. It's not trying to maximize returns in any single scenario. Instead, it's designed to preserve capital and generate steady growth across all scenarios. And because the allocations are fixed, you rebalance periodically. When stocks surge and become a larger percentage of your portfolio, you sell some stocks and buy more of the underperforming assets. This forces you to systematically buy low and sell high without emotional decision-making. Tony also emphasizes the importance of low costs within your asset allocation. Even the best allocation can be undermined by high fees. He strongly advocates for using low-cost index funds or exchange-traded funds to implement your allocation,
rather than expensive, actively managed funds. Another critical element of step 4 is understanding your personal risk tolerance and time horizon. A 25-year-old saving for retirement can afford to have a higher allocation to stocks than a 65-year-old who is about to retire. Tony encourages you to be honest with yourself. How much volatility can you stomach without panicking and selling? Your asset allocation should reflect not just mathematical optimality, but your emotional capacity to stay the course.
Step 5. Create a lifetime income plan. Turn wealth into reliable cash flow. Accumulating wealth is only half the battle. The other half is learning how to convert that wealth into reliable, sustainable income that lasts throughout your lifetime without running out of money. Tony introduces a simple but powerful framework called the 3-bucket strategy to help you think about this transition from accumulation to distribution. The first bucket is the security bucket. This bucket is dedicated to safety and stability. It contains low-risk, predictable assets like high-quality bonds, certificates of deposit, and potentially certain types of annuities that guarantee lifetime income. The purpose of this bucket is to cover your essential living expenses: housing, food, healthcare, utilities, no matter what happens in the markets. Knowing that your basic needs are covered, regardless of market volatility, gives you immense psychological peace and prevents you from being forced to sell growth assets at a loss during a downturn. The second bucket is the growth bucket. This bucket is dedicated to long-term wealth creation. It contains higher risk, higher return assets like stocks, real estate investment trusts, and equity index funds. The purpose of this bucket is to outpace inflation and grow your capital over decades. Because your essential expenses are covered by the security bucket, you can afford to let the growth bucket ride out market cycles without panic. The third bucket is the dream bucket. This bucket is dedicated to living your life and enjoying your wealth. It contains the profits and distributions generated by the other 2 buckets. You use this money for travel, experiences, hobbies, generosity, and the things that bring you joy. The dream bucket reminds you that wealth is not just about security. It's about freedom to live fully. Here's how the buckets work together in practice. You fund the security bucket first, ensuring your baseline needs are covered. You then allocate to the growth bucket to build long-term wealth. As your growth bucket generates returns, you periodically transfer a portion of those gains to replenish the security bucket and fund the dream bucket. This creates a sustainable cycle. Growth funds security and enjoyment, while security protects you from having to liquidate growth assets at bad times. Tony also discusses the role of annuities in lifetime income planning. While he cautions against complex, high-fee annuities sold by commission-based advisors, he acknowledges that simple, low-cost, immediate annuities can serve a valuable purpose, converting a lump sum into a guaranteed paycheck for life, similar to a pension. For some people, allocating a portion of their security bucket to an annuity can provide peace of mind that they will never outlive their money. Another key element of Step 5 is tax-efficient withdrawal strategies. The order in which you withdraw money from different account types, taxable brokerage accounts, traditional retirement accounts, Roth accounts, can significantly impact how long your money lasts. Tony recommends consulting with a tax-savvy fiduciary advisor to create a personalized withdrawal plan that minimizes taxes and maximizes sustainability. Step 6. Invest like the 0.001%. Steal the secrets of the ultra-wealthy. In this step, Tony Robbins reveals strategies and principles used by billionaires and institutional investors that are rarely discussed in mainstream personal finance advice. These are not get-rich-quick schemes. They are sophisticated, time-tested approaches to building and preserving extraordinary wealth. First, let's talk about tax efficiency. The ultra-wealthy understand that it's not just about how much you earn, it's about how much you keep after taxes. They maximize contributions to tax-advantaged accounts like 401k plans, traditional IRAs, and Roth IRAs. They use strategies like tax loss harvesting to offset gains with losses. They hold investments long-term to qualify for lower capital gains tax rates. And some explore advanced structures like private placement life insurance, or PPLI, which can provide tax-free growth and death benefits for high net worth individuals. Tony emphasizes that by taking taxes out of the equation, the time it takes to reach financial independence can be cut in half.
Second, the ultra-wealthy focus on legacy protection. They don't just accumulate wealth, they protect it and pass it on strategically. This includes creating revocable living trusts to avoid probate, using irrevocable trusts to reduce estate taxes, and implementing gifting strategies to transfer wealth to the next generation tax efficiently. Tony also stresses the importance of teaching financial literacy to your children early, so they are prepared to steward wealth responsibly. Third, the ultra-wealthy follow timeless investment principles that transcend market cycles. Tony distills these into a few core rules. Rule number 1, famously attributed to Warren Buffett, don't lose money. Rule number 2, don't forget rule number 1. This doesn't mean avoiding all risk, it means being extremely selective about the risks you take. Seek asymmetric opportunities where the potential upside is many times greater than the potential downside. Rule number 3, diversify across uncorrelated assets. As we discussed in step 4, this reduces portfolio volatility and increases the likelihood of steady growth. Rule number 4, never stop learning. The financial world evolves constantly. The most successful investors are perpetual students who adapt their strategies based on new information and changing conditions. Tony also shares insights about alternative investments that the ultra-wealthy use, such as private equity, venture capital, hedge funds, and real estate syndications. While many of these have high minimum investments and are only available to accredited investors, Tony encourages readers to educate themselves about these options and consider them as their wealth grows. He also warns that complexity and illiquidity come with these investments, so they should only be pursued with proper due diligence and professional guidance. Finally, Tony emphasizes that the ultra-wealthy think in terms of ownership, not just income. They build or buy businesses, invest in real assets, and create systems that generate cash flow independently of their time. This mindset shift, from trading time for money to building assets that work for you, is fundamental to achieving extraordinary wealth.
Step 7, just do it, enjoy it, and share it. The ultimate purpose of wealth. After 6 steps of strategy, mechanics, and planning, Tony Robbins brings us to the most important step of all, the human step. Because at the end of the day, money is not the point. Freedom, fulfillment, contribution, and joy are the point. Tony shares a powerful personal story about achieving massive financial success early in his career, only to realize that success without fulfillment is the ultimate failure. He had the money, the recognition, the lifestyle, but he felt empty. It was only when he shifted his focus from accumulation to contribution, from self to service, that he found true satisfaction. This step is built on 3 foundational decisions that shape every area of your life, including your financial life.
Decision number 1. What will you focus on? Your focus determines your reality. If you focus on scarcity, fear, and what you lack, you will feel poor no matter how much money you have. If you focus on abundance, gratitude, and what you have, you will feel wealthy, even on the journey. Tony encourages daily gratitude practices, visualization of your goals, and surrounding yourself with positive, growth-oriented people. Decision number 2. What does it mean? Events themselves are neutral. It's the meaning you assign to them that determines your emotional response. A market downturn can mean, I'm losing everything, or this is a buying opportunity. A financial setback can mean, I'm a failure, or this is feedback that helps me grow. The wealthy learn to frame challenges as opportunities and to maintain an empowering narrative about their financial journey. Decision number 2. What does it mean? Events themselves are neutral. It's the meaning you assign to them that determines your emotional response. A market downturn can mean, I'm losing everything, or this is a buying opportunity. A financial setback can mean, I'm a failure, or this is feedback that helps me grow. The wealthy learn to frame challenges as opportunities and to maintain an empowering narrative about their financial journey. Decision number 3. What will you do? Knowledge without action is useless. Tony challenges you to take massive, consistent action toward your financial goals. Start today. Open that account. Make that transfer. Have that conversation with a fiduciary advisor. Read that chapter. Small actions, compounded over time, create extraordinary results. Tony also shares research-backed insights on how to use money to increase happiness. Invest in experiences rather than things. Studies consistently show that spending money on travel, learning, concerts, and time with loved ones brings more lasting happiness than buying material possessions. Buy back your time. Use money to delegate tasks you dislike or are not good at. House cleaning, meal prep, administrative work, so you can focus on your highest value activities and relationships. Give generously. Multiple studies show that spending money on others activates the same pleasure centers in the brain as spending on yourself, and often more strongly. Generosity creates connection, purpose, and joy. Tony encourages you to build giving into your financial plan from the beginning, not as an afterthought. Finally, Tony reminds us that financial freedom is not a destination. It's a daily practice. It's the discipline of saving consistently. It's the courage to stay invested during volatility. It's the wisdom to keep learning and adapting. It's the generosity to share your abundance. And it's the gratitude to enjoy the journey, not just the arrival. Comprehensive Action Plan, your first 90 days. To help you translate this summary into real-world results, here is a detailed, phased action plan. Week 1, Foundation. Open a high-yield savings account dedicated to your emergency fund and initial investments. Set up an automatic transfer of at least 10% of your income to this account, scheduled for the day after payday. Write down your specific financial independence number using the formula: annual essential expenses divided by your chosen withdrawal rate. Journal about your current beliefs about money. Identify any limiting beliefs and consciously replace them with empowering ones. Weeks 2 through 4, Education and Optimization. Gather statements for all your current investment accounts, 401k, IRA, brokerage accounts, etc. Calculate the total fees you are paying across all accounts. Look for expense ratios, management fees, load fees, and administrative fees. Research fee-only fiduciary financial advisors in your area or through napfa.org. Schedule a consultation with at least one. Read one chapter of Money Master the Game per week, or listen to the audiobook during commutes. Month 2, Strategy and Allocation. Based on your risk tolerance, time horizon, and financial independence number, design your target asset allocation. Consider using Ray Dalio's All Seasons portfolio as a starting template. Select low-cost index funds or ETFs to implement your allocation. Prioritize funds with expense ratios below 0.2%. If you have an employer retirement plan, review the investment options and choose the lowest cost, most diversified funds available. Begin implementing your 3-bucket strategy. Calculate how much you need in your security bucket to cover 1 to 2 years of essential expenses and start building that allocation. Money Master the Game is more than a book. It's an invitation. An invitation to take control of your financial destiny. An invitation to learn from the greatest minds in investing. An invitation to build not just wealth, but freedom, security, and the capacity to make a difference. Tony Robbins does not promise easy answers or get-rich-quick schemes. He offers something far more valuable: a clear, principled, step-by-step roadmap that works for anyone willing to do the work. The strategies in this book have been tested by billionaires and simplified for everyday people. The psychology has been refined through decades of coaching millions. The result is a system that is both profound and practical. Remember these closing truths. Financial freedom is not about having unlimited money. It's about having enough money to live your life on your terms, to care for those you love, and to contribute to causes that matter. You don't need to be perfect. You just need to start.
Consistency beats intensity. Small, disciplined actions repeated over years create extraordinary outcomes. You are not alone. Millions of people are on this journey. Learn from others. Seek guidance when needed. Build a community of support. And finally, never forget the ultimate purpose: to live a life of meaning, joy, and contribution. Money is a powerful tool to serve that purpose, but it is not the purpose itself. As Tony Robbins says, the secret to wealth is simple. Find a way to do more for others than anyone else does. Become more valuable. Do more. Give more. Be more. Serve more. Your journey to mastering the game of money starts with a single decision. Make that decision today.
Money Master the Game is more than a book. It's an invitation to take control of your financial destiny, an invitation to learn from the greatest minds in investing, an invitation to build not just wealth, but freedom, security, and the capacity to make a difference. Tony Robbins does not promise easy answers or get-rich-quick schemes. He offers something far more valuable: a clear, principled, step-by-step roadmap that works for anyone willing to do the work. The strategies in this book have been tested by billionaires and simplified for everyday people. The psychology has been refined through decades of coaching millions. The result is a system that is both profound and practical. Remember these closing truths. Financial freedom is not about having unlimited money. It's about having enough money to live your life on your terms, to care for those you love, and to contribute to causes that matter. You don't need to be perfect. You just need to start. Consistency beats intensity. Small, disciplined actions repeated over years create extraordinary outcomes. You are not alone. Millions of people are on this journey. Learn from others. Seek guidance when needed. Build a community of support. And finally, never forget the ultimate purpose: to live a life of meaning, joy, and contribution. Money is a powerful tool to serve that purpose, but it is not the purpose itself. As Tony Robbins says, the secret to wealth is simple. Find a way to do more for others than anyone else does. Become more valuable. Do more. Give more. Be more. Serve more. Your journey to mastering the game of money starts with a single decision. Make that decision today.